help you navigate the space. So yeah, that's a little bit about us. Upcoming events, we do have our first in-person event next week at Factory Berlin. And this will be for women. It will be, riding the flow of your cycle and discovering your hormonal productivity. So that's just for women this time around. But we are also hosting a brunch at East Denver. We're looking for partners. So we've got a crypto mansion right next to the venue, and we're looking for sponsors right then. So that's basically on our agenda. Crypto taxes. I think this came up because everyone was like, help me. So Werner stepped in and said, okay, we did this in 2020 when we did the first workshop? I think a lot's changed since then. So I think Werner will go through the basics, and then we have time for questions after, because I know there's a lot of questions going on. So yeah, do you want to come to the front? Oh, you are here. Okay, I couldn't recognize your avatar. Whoops. Okay, maybe Chris. Okay, Chris, are you speaking today? It's fine.
I just want to be close to the action,
It's fine. If you want to be comfy, if you have difficulties walking, it's fine. Cool.
I can also go in the middle. Okay.
How about you stand on the table? Okay. No, I think back here's.
I don't think I can.
You do you. Cool. Let's go.
Take your spot.
And remember to please mute yourselves. Otherwise we won't hear about taxes. Yeah.
Nice. So, hello everyone. My name is Werner, and today we're talking about crypto taxes, but I'm trying to make it as entertaining as possible. So I also don't want to bore you with anything that's not relevant for you. So if you say you have questions, please use the chat. I'll have the chat open. Keep an eye on it. Maybe I'll not immediately answer your question, but then we'll save it for later. So we'll go through the chat, or if it just makes sense out of to have it in the context, then I'll answer it right away. My background is I have a degree in tax law. I was working for the tax office for almost 10 years. And then I always knew I'm not really good at working at a tax office. Just public state office were never really my thing. So I studied computer science, was on the way to transition into a developer position when I got to learn and hear about Bitcoin and cryptocurrencies many, many years ago. And then I was super fascinated, and also came pretty shortly after that into contact with the tax problem around this whole topic. I think we can go one slide further. And yeah, so then I learned about the huge challenges that came around cryptocurrencies and taxes. So I really got deep down into that very niche specific rabbit hole to learn everything that was there. And from there on, I started working with tax advisors. I probably teached, I think at that point, 500 to 1,000 tax advisors on crypto taxes, on courses. I've done a lot of work also for governance. So I worked with the Ministry of Taxes on their proposal. I worked with some of the wealthiest crypto people in Germany for their tax reports. And as founder of Pecuna, that's my main topic at this point, to help people create their tax reports that they then can hand into the tax office, and really work on all the special cases. So next slide. When I talk, it's always you really should pay your taxes on crypto. That's just my opinion, but actually you really want to pay your taxes. There is this myth going around that if you're doing anything in crypto, it's not part of the state system, it's not taxable, all these things, but that's not the case anymore. From a very simple perspective already. Next slide. easiest thing you want to do at some point is like cashing out, getting access to your money, and then also use that money for buying something. So one sec, I want to open my slides because there I have my notes as well. I think I shortened my slide deck, so I was missing a couple things now. But we can get to the next slide. There is the Lambo that I was looking for. So yeah, airdrops is one topic we'll definitely talk about. So yeah, latest when you cash out, when you buy something for your crypto, no matter if you buy it in crypto or not, there is usually something that involves taxes. So even if you cash out, then your bank statement will say something about crypto or on a crypto exchange. If you manage to pay your Lambo with crypto, then you still need to register it, pay taxes for it. So even then, the tax office has some information that you have some kind of wealth. They will probably not assume crypto, but money laundering or work under the table, something like that, more likely. But it's still relevant that all of these things will have some kind of tax implications. And if the tax office knows about it, they will ask a question. And if you're in a position that you need to defend yourself, it's always worse than go ahead and report it by yourself. This will give you a big advantage over if they start investigating you with tax fraud. That's always a not so nice position to be in. Yep, next slide. Also, tax evasion is not a small thing. There is even mandatory jail time if it's like over a certain amount of money that you did not declare. So this is some serious crime in Germany. It comes with hefty payments, starting from, of course, you have to pay your taxes that you missed out on, but also you need to pay fines, and it can even go up to, like, there is different kinds of tax fraud, but heavy tax fraud is even comes with jail time and up to, I think, 7 or 8 years, like really some serious jail time. Also, the tax fraud regulations in the last couple of years got a lot more strict when it comes to how people get fined and what is acceptable and what not. And as the chat already writes, we have some great regulations in Germany that everything that is over 1 year holding is tax-free. So that is some very good tax regulation, and using that rule in a positive way, in a way that helps you, will give you the chance to pay a lot less taxes and actually structure your taxes. So calculating the 1 year, I think next slide already explains that. So yeah, we're now talking about income tax. That means personal income tax. We're not talking about companies in this presentation. That will be too much if I also explain stuff for companies. To answer that one question, the 1 year holding period does not apply for companies. And if you go to the next slide, we have an overview of the different buckets where we in the crypto space are when we talk about taxes. So on the top left, we have the privates Veräußerungsgeschäft. I guess you probably have to go into full screen able to read that, and I'll need to do that too. So for privates Veräußerungsgeschäft, it means the 1 year holding period. We have the process of that you need to buy something and sell something. Then it's a privates Veräußerungsgeschäft. There is the free limit of 600 euro. So if you have a total profit of less than 600 euro per year in all your crypto trading, then it's also tax-free. Even if you're under the 1 year holding period, that's always a good amount. If you have like in between if you say you just buy stuff, but for buying you also have crypto to crypto transaction, like you move euro to an exchange. With euro you buy USDT, and with your USDT you buy the coin that you actually want. And with that USDT or with that ETH that you need to buy to get the actual coin, you make a small profit in the meantime. then you don't have to worry about those smaller amounts in between. And we are working with first in, first out. That was already mentioned in the chat as well. And a very important aspect of first in, first out is that you have account separation. So you do that calculation per account. An account means everything that can be separated. So every wallet is its own account, every exchange is its own account. Some exchanges offer to have like SEP accounts or a trading account and a savings account, depending on what exchange you're using. So all these things are separate accounts and can therefore be used for its own first in, first out chain. And with that in mind, you can, for example, put your long-term holdings on, for example, a hardware wallet, while your short-term trading assets that you want to use more often are on your MetaMask wallet, is a very typical thing to do. And so yeah, the 600 euro limit is total per year, and it's not a deductible amount, so it's really a limit. If you're 601 cent, you pay for the full amount. If you're 500 euro, you pay nothing. But you cannot say, okay, I have 1,000 euro and I can deduct 600 euro. That would be wrong. It's a limit, not a deductible amount. So then we have the next bucket. That's the one in the middle. It's called other income. And other income is basically everything where we generate yields from staking, lending, airdrops, everything else goes in this second bucket. Here we need to have some active part. Active part can already be like I'm putting something into a staking protocol, or a liquid staking, or a liquidity pool or something. That is already enough to start that active doing and goes into this amount. Here we also have a free limit that's not on my slide. That is, I think, 120 euro or something, because it's very small and in most cases not really applicable. So if you're only staking, or if I have like the clients who accidentally staked at some point, who didn't even realize it, then they got a couple euros, then they saw, oh, I have somehow incoming assets on my wallet, and then they unstaked immediately, then you can say, okay, that amount is part of that free limit. So then to the right, we have business. Business can be part of either a GmbH or a freelance, anything that has to do with like, it's like a job, you're actively doing something to generate that income. Also, mining is part of that business income, and also staking. In the staking thing, I do not agree with the Ministry of Taxes. What they say here, there is also court rulings still open. But for now, if you're doing staking, and with staking, I mean active staking, not liquid staking, exchange staking, or something like that. But if you have at home a staking node running where you're creating new blocks, then you're in this business area. So here you have a lot more taxes to pay and also a lot more stuff to do. Like you need to file different forms for your tax declaration. You need to pay more taxes. VAT is at some time a topic, and so on. So that's usually the area we want to avoid. Then in the smaller ones, there is capital income. Capital income only we're talking about in the area of margin trading. And there is a newer movement that says also everything that comes in the direction of lending, also including liquidity pools, could be part of capital income. But that's a very new opinion, and you should not count on that. Advantage of capital income is you have a fixed tax rate of 25%, which is usually lower than your personal income tax rate, which we have with all the other incomes that we had so far. Especially with the margin trading, there is one big disadvantage, and that is a loss limit. So you cannot deduct all your losses from your income, and especially in margin trading where you have a lot of profits and a lot of losses, the chance that you get liquidated and have a 100% loss is very high, is not good deductible. So there's a lot of court things going on, even in front of the highest German courts, the Bundesverfassungsgericht, is stuff going on. And yeah, your liquidated BTC Gigalong is part of that and will potentially, depends on the amount and what exactly you did, be not tax deductible. So that is a really big problem because a lot of people did a lot of margin trading, especially under traders, leverage trading, CFDs. There's a lot of different names for basically the same thing in one tax class that has that huge tax advantage. And as the last bucket, that is the income part. So if you're getting paid in cryptocurrencies, then you're in this area. But that's also not part of that presentation. Next. So now we're going into a little bit more details for the trading, because that's probably the most relevant for most of the people here. Go to the next slide. So we need to know how to calculate your gains. I think we covered that already a little bit, but in the next slide, we can look a little bit more into it. So the first in, first out is something I've already mentioned. So we have one wallet. In one wallet, there is multiple Ethereum purchases, for example. And if we sell now Ethereum from that wallet, we do not necessarily know which Ethereum, which ETH coin we exactly sold, because they're all the exact same, or Solana, of course, here in this crowd. So which Sol coin or token we exactly sold, and therefore we have to make assumptions on which ones it is, because we still need to calculate the profit. For calculating the profit, we need to know what was the purchase price, and for calculating the holding period, we also need a purchase date. And therefore, we always start with the oldest coin or token that is still in this wallet and go up to the newest one. That's all that first in, first out means. Okay, next one. And yes, account separation. That is also what I explained earlier. It's basically everything that you can separate will be separated, and you can do this calculation of first in, first out per account. And next slide. So in taxes, we always look for the taxable events, and those are, next slide. Oh, I skipped that slide. So taxable events are trading, so fiat against crypto, crypto against crypto just as well. So that's something that a lot of people don't keep in mind. Every crypto to crypto transaction is also a taxable event. What is not a taxable event is paying out from the exchange, like cashing out. Once you convert your crypto to euro, that will be the taxable event. But once you move it from exchange to your bank account, is not a taxable event. Also, trading against foreign currencies is a taxable event. So if you say you only traded against USD, it's just as well a taxable event. Yeah, so much to taxable events. And now we're coming to the special cases on the next slide. Just a brief overview: mining, staking, lending, airdrop, hard forks. We'll not be able to go into detail of all of them, but just that you've heard about. So mining, if you're really running your own mining rig, mining server, is considered business income. Same with staking. If you're running your own staking node, a validator node, full node, means you're most likely a business income. I do not agree with that, and I would be happy to go to court for that. But for right now, that is what we need to assume. That will be the final answer for your taxes if that's something you've did. Different is virtual mining, pool mining, cloud mining, all these things. So those are considered private investments. Same with staking. So if you're using liquid staking, exchange staking, a staking provider, something like that, then you're in this other income bucket that I mentioned earlier. Lending on some kind of lending protocol, also other income. Other income will be taxed at the time you receive the assets with the value of the assets that you receive, and it will be taxed again once you sell it. So if you hold it for less than 1 year and you sell it, then the difference between the amount that got taxed already and when you sold it will be taxed again. And now we're coming to airdrops. Yeah, it doesn't really matter. With airdrops, the German Ministry of Finance really went above and beyond and wrote, I think, 2 pages just about airdrops, made it super complicated. So there's a lot one needs to know about how airdrops are taxed, and it's still a little unclear because their guidelines are just not what's happening in the real world or in the crypto world. So the Ministry of Taxes said for airdrops, we need to see if there was a exchange of service. And as examples of exchange of service they bring is, for example, if you had to upload personal information or if you had to upload something on a platform, that is a exchange of service. If you had to repost something on Twitter, it's like the 2018 airdrops where you had to like sign up for something and do something and then you qualified for an airdrop. That's what they considered. So then it's an exchange of service and then it's taxable as other income. So it's part of that second bucket that we talked about. If there is this kind of exchange of service, then there is another check we need to do. And that is, was there some kind of randomness involved? Because if there is randomness involved, then this overrides the exchange of values. This means if there was like some kind of lottery or some kind of uncertainty involved, which is very weird because they don't really define if uncertainty only gets to if you get something or also to the amount. Because usually with airdrops, you don't really know that you get something. It is kind of random in the sense that only the provider, whoever airdrops you something, knows really about it. It's unclear if you knew at the time you did use the whatever protocol to get the service, to get the airdrop, it's already relevant to know about the potential airdrop and all these things. So airdrop, in my opinion, highly overregulated, and also the results. So if it's a tax-free airdrop, then they still need to, then they require another check if it maybe was I'm missing the English word, like inheritance and present tax in Germany, Schenkungssteuer. And this could also be the case. So if they say, so the whoever gave you that airdrop has a interest that you received that airdrop, which is very weird because they obviously gave it to you, then another tax could be relevant for that airdrop. They mention as well, but don't really define the exact circumstances. And then there is still the 1 year holding period. So if you sell it within that 1 year holding period, your airdrop, it doesn't really matter. All that, what I just explained, goes to nothing because then you have to tax the full amount anyways. It's just a matter of how much you taxed when you received it and how much you get taxed when you sell it. And it might be in 2 different calendar years, but otherwise you get taxed for the full amount. So an airdrop is only really, oh yeah, gift tax, that's probably a good translation for Schenkungssteuer. So an airdrop is only really tax-free if you haven't done anything for it. If you have done anything for it and it's kind of random that you received it, then it's also tax-free and you need to hold it for 1 year. If you sell within 1 year, then it doesn't really matter because then you tax everything anyways, which would be a good regulation in the first place. Next thing is hard fork, another topic that's completely overregulated in my opinion, and also compared to how relevant it is anymore. Very complicated. So for a hard fork, the government says that you need to treat the new forked blockchain as if it was always there and separate all your transactions based on what happened on the old blockchain and what happened on the new blockchain. So this is a tremendous work when it comes to reporting and regulating, and also not practical at all. Luckily, I think the time of the big hard forks is over, so that's not something that is really relevant for right now. Yep, we're going to the next one. And overall, I think it's more important to optimize taxes than to try to not pay your taxes, because as I explained, there's a lot of ways that you don't have to pay taxes, starting from the 1-year holding period in Germany. That gives us a great opportunity to structure and optimize taxes over tax fraud. Yeah, next slide. And also with the most recent regulations, there's, for example, MiCA, that's from the European Union, one regulation that regulates mostly exchanges and custody provider and some other DeFi protocols. Those now have a lot of regulations regarding KYC and how they have to run their business. And with those regulations, more and more information also will get gathered and will have to be reported also to state offices. So at some point, or right now, it's just a matter of time till state offices, like for example, the tax office, knows about that you own crypto assets and even what you traded and how much you traded. Also CARF, it's another regulation from the OECD, Crypto Asset Reporting Framework. So yeah, it's really just a matter of time. And at this point, tax fraud is not really an option anymore. And yes, they can go back 10 years. I think that's on my next slide. Yep, you can go one slide ahead. And yeah, I think at this point, it's more important to really optimize your taxes for crypto gains than to optimize for taxes. I think you can save a lot of money by just using the 1-year holding period, using strategies like HODL, dollar cost averaging. These are all great strategies. You just have tax-free assets and then report them and be fine instead of getting in trouble with the tax office. Yeah, next slide. I think that's, we already covered that reporting taxes is always better. Having to defend yourself. Okay, next slide. And oh yeah, that was my slide for the 10 years. So do you remember what you've done in 2014? Would you like to be liable for your 2014 self if you go back in time? It's a long, long time ago, 10 years. So make sure that your 2034 you doesn't have to worry about what your 2024 you has done in crypto and DeFi and all the other things. So yep, better report your taxes. Next one. Okay, already covered that one. That optimization is definitely possible in Germany. And yeah, one important thing. So everything I've said so far was for Germany. Be aware that other countries might have widely different regulations and might not apply to your legislation based on where you are based or where your tax residency is. Yes. And yep. So feel free. We are doing a lot on social media, posting a lot about also topics that are coming up, starting from the Bitcoin spot ETF, how that is taxed, about different DAOs. I think we have one article about Nouns DAO, for example. about protocols. Eigenlayer was one we did recently a big article about. So follow us on our social media accounts to stay up to date. We're posting a lot about what's going on in the governance, what government is up to, and so on. So then you can learn about the most important things and stay up to date with your crypto taxes. And thank you so far. And I think we already have a couple questions that have not been answered yet, but feel free to add more in the chat now, and then we'll go through the questions in the chat.
We can, since we're all able to talk, we can also just like raise our hands. So if you have a question, you can wave and speak. Let's use this to our advantage. Or we can just go back to the chat and go through what was already asked. So should we go through the chat, and then if there are questions afterwards, people just wave their hands? Who has a question that isn't in the chat? You just click your avatar to wave. Okay, let's just go through the chat.
Yeah. So we had, which is the best country for crypto tax-wise? I mean, there is countries that are good tax-wise in general, starting with Dubai, who has no income tax at all. There was always the tax haven Portugal for crypto people. That's getting less and less. That was more a bug than a feature, let's call it. So it was just a regulatory gap, but they are implementing crypto tax rules right now, as so far that I know. And a lot of things will change for Portugal, if that's something you have in mind. With the 1-year holding period, we're actually pretty good. Like if I read international blog articles about best crypto tax countries, Germany is usually listed there because of that 1-year holding period. So can you explain the 1-year rule in detail? Maybe we talk about it more. Do you have a specific question that wasn't answered yet?
Werner, you missed one above, which I'm curious about. The 1-year tax-free is only up for 20K, 20,000 euros. It's from Nina, and Aris just reposted it.
Okay. I was going from the oldest one to the newest one. Yes. So yeah, but the 1-year tax-free is only up for 20K. No, the 1-year tax-free is no matter how much. There is no limit to the 1-year tax-free. The 20K was the maximum loss you can deduct in margin trading.
That's good news.
And airdrops will be taxed up from this year, so no. Airdrops will also, or are also taxed for past years. So the writing from the Ministry of Taxes is just a clarification, so they didn't change anything in the tax law, and therefore it also applies to older years. So this clarification was from 2022, but it also applies to all former years as well. So is there any kind of Wegzugsbesteuerung? So Wegzugsbesteuerung only applies if you have some kind of GmbH. So this should, in that context that we talked about it in this presentation, not be relevant, Wegzugsbesteuerung. So private assets are not part of the Wegzugsbesteuerung. How to tax a grant received in crypto? Yeah, there is a rule that grants are tax-free in Germany, but it doesn't apply to crypto, mostly because what crypto calls a grant is not a grant in German tax law. So with a crypto grant, it usually comes with a very detailed specifications of what have to be done, or if it's or what has to be done in the past already. And we come to retroactive grants, and those are considered income based on the volume. And if it's a one-off thing, it could be other income. If it's something that happens on a regular basis, or it's your actual full-time job, then I would say it's probably or most likely freelance income, and is therefore fully taxed in Germany. Yeah, feel free to speak out or raise your arm. Use your chance to ask all your questions. I know there's more.
There's more that just came in. I think is that Maggie or Ale? Sorry, I just doxed you, Maggie. Do you want to speak?
Yeah, it's me, but I'm cooking, so I wrote down.
I have one rule: no cooking.
No, I was wondering how the law changed in regards to staking, because I remember that there was something from 1 year jumping to 10 years once you start staking. Is this still valid?
No. The law actually didn't change. The law is still there, but it was never 100% clear if this extension of the holding period applies for staking. So in the law, it says for assets that are used to generate other income, the holding period is not 1 year, it's 10 years. And that was introduced to avoid some kind of tax fraud scheme where you could avoid paying taxes by using that 1 year holding period and also generating income. But there were already a lot of exemptions from courts that said doesn't apply in this case, it doesn't apply in that case, including one when it comes to generating interest on foreign currencies. And in the end, the German Ministry of Finance followed that argument and decided that, so they just completely ruled it out that this is not the case for crypto. So also the same discussion happened around liquidity providing, lending, and so all these things were considered to potentially have that extending holding period, but that was just completely ruled out.
Meaning this does not apply anymore.
Yep, it doesn't apply.
Okay, thanks.
And that is also binding because that clarification is binding for all tax offices. So if in your case, your local tax office says 10-year holding period, then you can say no, they have to do 1 year holding period. The extension to 10 years does not apply in crypto.
Awesome, thank you so much.
You're welcome. Okay, now we're getting some more questions in. What do you think of tax software like Coinly /accountant? What do you recommend for people to submit their crypto taxes since it's so hard to find crypto familiar tax attorneys or tax accountants? Yeah, it absolutely is. It's close to impossible. So finding a tax accountant in general is already really hard. Finding one that is familiar and good with crypto is a lot harder. Yeah, familiarize yourself as much as possible with the topic. Prepare yourself as much as possible. Tell your accountant that this is an area that you already prepared as best as possible, and that he doesn't need to do a lot in this area. That's one way to go to make it as easy as possible for you to find a tax accountant if you want one. Otherwise, you also have the option, the possibility to file your taxes yourself. But that comes with the disadvantage that you have also the full risk around anything related to your taxes. It is a really big problem. I'm very aware of that. But I don't really have a good solution either. So we're trying to get tax advisors to familiarize themselves with the topic and also to make it easier for them. But it is just extra level of complicated. The space is moving so fast, they're barely able to keep up. And therefore it is hard for them to accept clients who have anything crypto related. I have a couple that I recommend, but even with them, I've heard it's hard to get into to be accepted as a client. what do you think of tax software like Coinly? So yeah, definitely recommend using some kind of software. If you have like really done barely anything, then you can try to do it with an Excel sheet. But once there will be that point where you realize, okay, it's getting complicated and your formula is getting more and more. And to implement first in, first out with account separation in Excel is getting really hard. So at that point, it's probably time to swap over to some kind of tool that's specialized for this question. I would say Coinly is a good one. In Germany, Cointracking and Blockpit are very popular. And yeah, that are, I would say, the biggest ones. So then how can I borrow USDC against my Solana? Where does this incur taxes? So for using a lending protocol, which you would do at that point, it doesn't really come down to a taxable event. So putting money into a lending protocol is just like a different form of storing it. Borrowing against your collateral is also just, yeah, you're taking out a collateral that you need to pay back at some point. So that's also not taxable. And the same the other way around with paying it back. So the whole process around borrowing lending is usually not involved with taxes. It's just a little bit more complicated to track the whole process. So next question, for the 1 year tax-free, I would need to withdraw from LP staking, etc., and hold for the 1 year. No, the liquidity providing, staking, and so on does not break your holding period if you do it correct, let's say. So there is a slight difference between, like, let's, for example, take Lido as a liquid staking provider. If you're using Lido, you can either buy STETH as staked ETH, or you can also mint your STETH for your ETH. And if you're minting it, then you're still holding the same asset. And the STETH is more like a liquidity token that just proves that you have the right to get your original ETH back, but then it's the same holding period. If you're swapping your ETH against STETH, which you might end up with the same result and the same assets in your wallet, but then you have a swap, it's a different asset, and then you have like realized a profit at that point, and then you also need to hold the STEs for another year before you can swap it back tax-free. So from a tax perspective, it always makes sense to mint your own staked ETH tokens. So does the 1 year also count for LSTs? Any token, as far as I know, as long as you stay in the token. What do you mean with LSTs? I'm not familiar with the. Oh, liquid staking token. Yeah, thank you. That's what I mean, Lido is, for example, a liquid staking token. So I think the question is answered already. Or do you need more explanation around that?
Okay, so I think we're coming up to an hour. I think we have 2 minutes to wrap things up. Are there any questions where you're like, I cannot leave this room and I cannot file my taxes unless I know this? Speak now or forever hold your peace. You've been all very patient. No? Okay.
And then we have like one more question from Leonie in the chat that I can answer.
We'll do one more question and then we'll wrap it up because
wrap up, yeah.
but this will be available on YouTube. Werner is around in Berlin and yeah, comes to our events sometimes and is available. So I don't know if you want like a flurry of questions, but you're in the community, you're not going anywhere. So reach out.
Also, sometimes you can find me at Factory. So, yep, feel free to reach out and connect. So, what about swaps that have two transactions from altcoin to wrapped ETH to USDC? Is it taxed twice, or can it be seen as one transaction? Either way, you're ending up with the same result. So you're not making any profits in between. So if you're going directly from the first to the last one and make that one transaction, or if you have that in between, as it is one transaction, also the price will be the exact same. So there will not be any profits in that additional swap. If it's easier for you, or if your tracking tool makes it into two transactions, it's fine, just leave it. If you need to do it manually anyways, which is often the case, you can also just skip this in between step. You have the same purchase price, you have the same acquisition date, so it doesn't matter. And one last question for you, Zoe. I think Gary wants to know where he can watch this on YouTube later. You can answer this one.
Yeah. So we will put it on the Crypto Girls Club YouTube channel. If you search Crypto Girls Club, you will find us, and you can subscribe to us. And we'll also put it, we'll announce it on our Twitter. So just follow Crypto Girls Club and we'll post it there. Or we can send it around in the Luma as well. Actually, that's a good idea. Sweet. Cool. Well, I hope everyone enjoyed this experience. Some of you looked delightful today and it was good to see you. And yeah, feel free to check out the space. It's pretty cool. And I will see you soon.
You're around. Bye-bye.
People can speak, it's very eerie. It's like, no. Not your average networking, I guess. But yeah, awesome work. Thank you, Werner, so much for doing this again. And we can pick this up in a couple of years when Micah's been, gone through and yeah, things are different again.